The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltale's Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham, the Cash Flow Desk.
Quick note, this show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. We're still early. This is a pilot, and we want to hear what's working. Here's the week. Being cheap stopped being safe. The cheapest large cap in healthcare spent the week with a federal prosecutor at the door. The retail name everyone screens as cheap is being handed customers by a tariff. And while the market was busy repricing the cheap stuff, the most expensive trade on earth, the AI Buildout, just kept writing bigger and bigger checks and got punished for it anyway. On Wednesday's main show, episode 2624, Hunt, Jason, and Mike worked through the economics of that buildout, the data centers, and the sheer physics of powering them. We're going to put the cash flow lens on the bill, because this was the week the bill started showing up in 3 different places at once. Start with the most expensive trade in the market, because this week it got complicated. For 2 years, the AI story was demand. Is it real? How big? How fast? This week, the question flipped to cost. Who delivers it? Who powers it? And whose balance sheet carries it? And here's the contrarian note hanging over the whole thing. As Bill Maris put it on All In this week, quote, "$1 trillion in spend commitments on $60 billion of revenue, and now you're going to go to the public and hope that retail is going to pick that up." Hold that thought, because 3 companies just tested it. Start with Oracle, because it did exactly what it promised and got punished for it. It delivered the backlog it said it would, and the stock fell 10% anyway. Page 2 of the memo. Remaining performance obligations hit a record $638 billion, up 363% year over year. Cloud infrastructure revenue up 93%. They did the thing. Marcus, why did doing the thing get them sold?
Because the market stopped grading the backlog and started grading the bill. Oracle's trailing free cash flow is negative, minus $21 billion, because they spent $48 billion on CapEx over the last year to build the capacity behind that backlog. So there's no multiple to quote. Don't reach for one. It's a negative number. What prices Oracle now is one question. Does $638 billion of contracted intent convert to cash before the interest on the build eats them? They raised the capital plan into a tape that no longer claps for capital plans. Maris's line is the bear case in one sentence, and Oracle just walked straight into it.
So next door, the power bill. NextEra just made the biggest bet in the history of regulated utilities and got the same treatment Oracle did. A $67 billion all-stock takeover of Dominion Energy, the largest regulated utility deal ever, built explicitly to power AI data centers, 30 gigawatts of it by 2035, with Google and Meta already signed on. The stock fell 9%. Marcus, what does the grid cost?
It costs more than NextEra has. This is a utility that already carries 16 times debt to free cash flow, and it's buying the biggest deal in the sector's history. They're paying in stock, not debt, which is the tell. They're funding the build-out by diluting, because the balance sheet can't borrow its way there at 41 times free cash flow. The 9% drop isn't the market rejecting data center power. It's the market asking who eats the cost of building it and deciding, this week, that the answer is the existing shareholder.
And the third bill is memory, where Wall Street has completely lost its composure. Micron, page 5, reports a week from Wednesday, and ahead of it, price targets went from $550 to $1750 in a matter of days. Micron got certified for NVIDIA's next-generation HBM4 memory, and its entire fiscal year production is already spoken for. One more tell you won't see in the price. The TalNexus hiring tracker shows Micron added 200 roles last week, hiring at full-cycle pace. Marcus, the stock screens at 100 times cash flow. Is that insane?
It looks insane, and it isn't, and that's the whole trick with memory. The 100 times figure is trailing free cash flow at the bottom of the cycle. It tells you nothing. Price it forward. Consensus earnings put Micron at about 7 times next fiscal year. Trailing cash flow is already up more than 5-fold off the trough, and revenue is guided to grow 60+%. You don't value a cyclical on a trough multiple. You value it on where the cash is going. And forward, this is a single-digit multiple. The risk isn't the price. The risk is that the whole supercycle thesis, Oracle's backlog, NextEra's gigawatts, Micron's HBM, is one connected bet that AI demand is durable. 3 names, 1 wager. The print on the 24th is the next data point on whether it holds.
Now, the other half of the market, the cheap half. Two companies, both trading at single digit ish multiples, both cheap for a reason, and the reasons could not be more opposite. One is being investigated by the government for charging too much. The other is being handed customers by the government's tariffs. Same week, two service businesses, two completely different verdicts on what cheap means. Here are the headlines, side by side. UnitedHealth, all the way back on page 19 of the memo. The CEO, Andrew Whitty, resigned. The company pulled its full-year guidance, and the Justice Department opened a criminal and civil probe into whether it inflated Medicare diagnoses to juice reimbursements. The stock is down about a third from its high. And CarMax, page 8, reports Wednesday, first print under a new CEO with an activist on the register, into a tariff backdrop that's pushing buyers out of new cars and straight onto its lots. Marcus, which kind of cheap actually pays you?
Take the scary one first. UnitedHealth trades at 14 times trailing free cash flow, a 7% yield. On the screen, that's the cheapest quality compounder in the market. Here's the problem. The thing generating the cash is exactly what the DOJ is investigating. The free cash flow comes from Medicare Advantage billing, and a federal prosecutor is now asking whether that billing was fraudulent. So you're not buying 14 times earnings, you're buying 14 times a number that's under subpoena. Cheap doesn't help you when the regulator is auditing the numerator.
And yet the stock just rebounded almost back to its high. Make that make sense.
It doesn't, and that's the tell. In the same 2 weeks the probe widened, 6 different shops raised their price targets, and Bank of America went the other way and cut it to neutral. So the sell side is openly split on the same name in the same fortnight. That's not a market pricing a verdict. It's a market pricing a coin flip on whether a federal probe breaks the cash engine or just dents it. When the analysts can't agree which, the multiple isn't cheap, it's unresolved.
So UnitedHealth's cheap is a question mark. What's CarMax's cheap?
Cheaper on the screen than in the business. Price CarMax on earnings and it's a mid-teens multiple, about 15 times forward, a normal retailer, not a coiled spring. So the bet was never the multiple. It's the setup. Tariffs added thousands of dollars to new car prices. Used demand is the spillover, and there's an activist pushing the new CEO to convert it. The test on Wednesday is one number, used unit volume. If that's accelerating, the multiple re-rates. If it's flat, it's just a tired retailer at 15 times.
So one cheap stock where the earnings might be fiction, and one that's barely cheap once you do the math. Marcus, ever the optimist.
Ideal in denominators, but the asymmetry is real. UnitedHealth's downside is a business model the government breaks. CarMax's downside is a soft quarter. One is binary, the other is just cyclical. Same word, cheap, two completely different bets.
Mark the calendar. Wednesday tells us which one. Two more to close, both moving fast. Moderna got a different kind of government attention, the bad kind. Health and Human Services terminated a $590 million contract for Moderna's bird flu vaccine and canceled 22 more mRNA research contracts across the board under the new RFK Jr. vaccine policy. There's an FDA advisory meeting Wednesday on an mRNA flu shot. This is the same theme as UnitedHealth from the other direction. Washington isn't just regulating healthcare this year, it's picking which platforms live. mRNA just got told it's on the wrong list. And Intel, remember Intel? Up 250% this year, and almost nobody noticed. The catalyst this week, Google committed more than 3 million of its TPU chips to Intel's foundry for 2028, pulling that order away from Taiwan Semi. Bank of America double upgraded the stock straight from sell to buy. After a decade of being the company the Buildout left behind, Intel spent this week being the company the Buildout came back to. That's the show. Wall Street's consensus this week, UnitedHealth is a falling knife, and the AI infrastructure names are crowded. One of those is wrong, and it's the one nobody wants to touch. Here's the through line into Monday. Being cheap stopped being safe this week, because the thing setting the price wasn't the business. It was the government on one side, and the Buildout's bill on the other. UnitedHealth at 14 times with a prosecutor. CarMax at mid-teens with a tariff at its back. Oracle, NextEra, and Micron spending into the doubt. Cheap got cheaper, expensive kept spending, and the market spent the week deciding it doesn't trust either one. The hiring data we cited on Micron is from talnexus.com. You can pull up the cash flow memo yourself at telltales.us. The forward week is loaded. CarMax reports Wednesday, FedEx the following Tuesday in its first quarter as a pure play after spinning off freight, and Micron Wednesday the 24th. And Hunt, Jason, and Mike are back Wednesday on episode 2625. We'll see you next Saturday. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase, or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.